Hello everybody, Jackson here with the Well Squad. Today we'll be talking about the stock market, mostly the small companies, less than $10 billion in market cap, that have been absolutely destroyed within the last year. What I'm trying to show in this video is basically comparing these to the 1999 tech stock crash. Back then, a whole bunch of tech stocks were going crazy. We could actually look sidebar from what I was trying to talk about. But let's look at QQQ, right? So QQQ is the tech index. Back in 2000, it was at $100 a share, right? Now it's at 270. So it went from 100 down to 20, down to 80%. So most of the tech stocks back then were down 80% within what we could actually see. So 120, March 1st, August 1st, right? So 2002. So it took longer than 2 years to fully crash 80%, this index. Now we're looking at DocuSign. DocuSign was the first one on our list for stocks under $10 billion market cap, with a performance of down 75% within the last year. Looking at DocuSign, we are seeing the price go from 314 to the current price of what's that close? 47 or so, down 85%. Close 46, okay. So down 85% within August to now. So little more than a year, not 2 years like the index shows, but that was back in 2000. So maybe things have sped up. But what I want you to know is a lot of these companies that have been getting destroyed, a lot of them won't last, right? You can see DocuSign was making good money at one point. Still a profitable company. Matter of fact, it's actually making money, unlike most of these other stocks. However, down 80% within the last year. We could actually see the performance here on Finviz. So performance on the year down 80%. Twilio down 82. Roku down 75. Okta down 76. Generac down 75. Don't know that. Let's do United States. Basically, guys, what I'm trying to tell you is like a lot of these companies will not last. They will go bankrupt and they will not come back from that. Something that we are seeing right now actually is the start of that. So we're looking at Carvana. We've talked about Carvana in the past. It's a company that is losing a lot of money, so much so that they cannot last another year with all the money that they're losing. So they lost $2.67 a share this latest quarter. And the quarter before they lost $2.35. Quarter before they lost $2.89. Quarter before they lost $1. Quarter before they lost 38 cents. And the quarter before that they actually made money. So it's been 5 quarters since they've made a single dollar in profit. I do believe the company cannot last another year. I'm pretty sure that's what we saw. And I think it's the start. Carvana was one of those where, check the price, $3.77. Now it's going for $8. That is more than 90%. That's 97, 98, almost 99% in a year's time. So this is essentially just coming back to reality. It's a good thing if you are a long-term investor in this market. It's a bad thing if you hold these stocks. Reason I say that is all these companies getting down 90% from where they've been, that doesn't mean that they'll recover fully. Doesn't mean that they'll recover slightly. These companies could go bankrupt, but there will be, out of these many tech stocks that we have here, most of them actually are just these wildly volatile companies like Peloton at $10, Ring at 36, or Ring Central, QuantumScape, Rapid7, Wayfair, Lyft at $11. Lyft at $11? Are you kidding me? I didn't know Lyft was that low, and to be honest. But anyways, out of all of these companies, there's going to be some gems, and that's our job, is to find these companies when that does happen. Lyft at $11 is insane. I remember getting a free stock from Robinhood when Lyft was like in the 70s. So maybe not in the 70s, maybe it must be in the 60s or 50s. I remember it was a nice chunk of cash for one stock, but now it's $11. So companies like Lyft, Uber, Peloton, mostly well known, right? You have to think back 1999, 2000, Microsoft was around. Microsoft got blown and torn to pieces, but now it's the second largest company. So Microsoft was trading for $57. See that here, $60, crashed down to a price of 15. So Microsoft didn't get hurt that badly, down 70% compared to what we've seen stocks down 90%. So the better companies most likely will not be hurt as much as these literal borderline bankrupt companies. That's what you have to look for, is companies that maintain their management, maintain their sanity, keep bringing along new products to the market, and potentially, deliver some nice returns. There are gems in here. Not all of these will go to zero. Not all of these will fully recover. Actually, a very, very, very few will. But out of those very few, a lot of them can keep going in the future. It is up to you to find those picks. Hopefully, you're up for it, right? It's a tough task to say the least. For example, Peloton. I know too many people that lost too much money in Peloton because what we know now, it was a trend, right? It was the COVID crisis that helped this company like crazy, right? That's why they were able to produce these machines when people cannot go to the gym and work out because they can't go to the gym. They have to work out from home. So they were actually making money for a short period of time. You can see they had 3 quarters where they made money, and now they're losing $1.20 a share, $3.68, $2.27, $1.39, $1.25, $1.05 a share. Peloton at this rate cannot last, right? Same with Carvana, same with a lot of these other companies. Wayfair, for example. Wayfair's been around for a long time. So I don't know if I could really speak on behalf of Wayfair compared to these other companies like Peloton, Carvana. But Wayfair is at the very depths of COVID prices, right? They're losing $2.80 a share, $2.30. Right now, Wayfair is losing $2.11, $1.94. So it's not as bad in terms of the economics of Wayfair, but the prices are just insane. They're making a lot of money during COVID. A lot of money. And prices were $300. Now they are $30, down 90%. Who knows if Wayfair will climb all the way back up? I doubt it. I don't think Wayfair is one of those companies, but I do think some of these companies are. And that could be some research that you set aside and look into whenever you would like. But that's what I would do, guys, and that's what I am doing. I'm looking in these companies, seeing if I like anything, and that's a speculative position. So you have 90% of your portfolio in core positions, right? Mostly index funds. Companies like Apple, Microsoft, something like that. And then you have 10 or 5% in speculative, right? Throw it and hopefully it goes to 100. Or it could go to 0, but you're not financially on the hook as much as if you bet your entire portfolio on it. So hopefully that makes sense, guys. I wish you well over the Thanksgiving, and I'll see you Black Friday.